Hello, and welcome to Credit Matters, the podcast where credit absolutely matters. I'm Shankar Ramakrishnan, your host and head of US credit and global market engagement at IGM. I'm here with my colleague and co host, Bruce Clark.
Morning, buddy. How are you?
Morning, sir. Morning. He's the head of rates market coverage. Today, we are going to talk about tightening credit spreads in one of the riskier parts of the credit universe, which is high yield and leverage loans. As investors look to lock in the higher yields on offer, spreads on these asset classes are touching new record tights. Are investors overlooking credit risks? What's driving spreads tighter? And even the record levels of issuance? These critical questions will be addressed by Stephen Burgess. Welcome, sir. Welcome.
Thank you.
He is the head of leverage finance at US Bancorp, where he has helped build out the debt capital markets business since joining in 2015. Burgess leads a team that originates and syndicates high yield bonds and term loan Bs. He previously worked in leverage finance at Barclays and began his career with Lehman Brothers. So that's a great bio to have, Stephen. Welcome.
Thank you for the warm welcome. Don't get introductions like that on daily basis at work, but I'll take it.
Thank you very much. Thank you. And so let me kick off with the questions, though, Stephen. To kick it off, I wanted to understand, where do you see the direction of interest rates? We are seeing a lot of mixed messages throughout this year. There was times when rates were expected to be cut. Then there is times when the US rates are expected to be hiked. And now some people are talking about hold, some people are talking about hike. So how do you, from where you sit, how do you see the direction of interest rates this year?
Yeah, it's a very topical question, and one that we obviously look at kind of on a daily basis. I think anyone in a origination fixed income business or trading business typically will look at the WIRP screen on Bloomberg multiple times a day, which gives kind of the Fed funds expectations for where rates are going to go. And as we all know, it changes. It's a very dynamic screen that changes often, and
Right.
You can get very different views on a daily basis. So, kind of where we are now, and what my focus has been on is just the period in which we've been accustomed to, with this narrative around coming off 5.25% to 5.5% Fed funds rate was
Right.
the expectation, and we have come off of that. I think where my inclination on where we're going to go is, no one's a predictor of kind of the markets, but I think we will likely probably be in this environment for a prolonged period. There's a lot of factors that are inputs to kind of my thinking around that. One is
Right.
just the commodity price environment that we're in is obviously very volatile, and it's definitely had a read through to inflation,
Right.
just given what's going on in the Middle East. The other thing I think I look at is kind of the employment side of the picture.
Right.
Yeah, the latest number was on the weaker side, and the PCE and the CPI and the PPI this week were more tepid than I think people, or at least what the estimates were. So the narrative around kind of rate hikes, I think, is probably the weighting there is more than it will be towards cuts. My personal view is I think we'll probably likely hang out kind of in the range that we currently sit in today. Obviously he's made some comments, initially in his first press conference in June, I think, that tilted towards the hawkish side. And I think more recently it seemed a little bit more measured in terms of what he's going to look at. But it's the factors kind of feeding into the analysis around where rates are going to go, I think will kind of predispose you to think that we'll be in either a flat environment or slightly increasing. I think personally that will probably be flat for the year. I know that's counter kind of to what the Fed funds futures will tell you, but I think some of the readings more recently have been supportive of kind of that stance.
Right.
Yeah,
So more like on a hold basis rather than a.
Yeah, Stephen, I'm in your camp. I mean, what I hear you saying is that the bar is probably fairly high for moves in both directions for interest rates.
Correct.
Right now. Yeah.
Yes, agree.
Now, the new Warsh Fed? I mean, it's early, obviously, but what he's proposed, has that sort of changed, your outlook on what the potential trajectory of rates could be? In other words, to me, he seems more willing than some of the members of the FOMC board to look through this, pop up in oil prices, from the Iran war. Do you sense any change or customers looking at interest rates differently since he came aboard?
Yeah, I think it certainly feels like a pretty distinct change in kind of posture and in communication with the street. What he's kind of communicated in terms of his views on providing forward guidance, his views on the quantitative easing or tightening, I guess, with Fed balance sheet runoff. He doesn't seem to be a fan of the Fed holding almost a $7 trillion balance sheet. So yeah, I think as we talk to issuers, it's going to be harder to kind of discern what their motivations are, or not motivations are, but what kind of their intentions are, I guess, because the Fed has just been so explicit recently, and people have been able to kind of make decisions and act in accordance with what they've been publicly stating. I think that'll be curtailed to a degree. I think what's interesting is there's a lot of public commentary out there around kind of the direction of the economy. Banks obviously I think, have kind of a unique insight into some of that, forward looking, just given kind of the nature of their business and them being a lender to almost every sector in the economy, from the corporate side to the consumer side. So I think bank earnings may get a little bit more attention with the Fed direction, but the conversations we've been having since he's been in the seat have been more like just kind of need to wait to see what actions he's going to take when he has a chance to do so. I mean, the commentary is definitely helpful, and you can see people kind of seize upon each word, sentence, and paragraph that he's publicly stating. But it seems to be, initially, at least to me, kind of from the June conference to kind of where we are now, it's softened a bit, and it doesn't seem like people think he's going to be kind of run away to the upside on rate hikes, like maybe that first. Not that he was going to be overly aggressive on it, but he was going to be certainly, I think, more aggressive than previous regimes. But again, like we're starting from doesn't feel like 2022, because we're starting from a period of, I mean, we're in the mid threes on Fed funds now versus sub 50 basis points in 22. So there's a little bit of tight policy kind of in the market now, just given where the overall level of rates are.
So basically, the bet here in the marketplace is whether the new Fed chair can tighten financial conditions sufficiently to rein in inflation without having to raise interest rates. I mean, if you read between the lines, I think that's what he's trying to say, and the verdict is still out on that. Clearly, half the people think that he can, half think that he can't. But as we move forward, it seems as though that's the setup in the marketplace. And while there's still tightening priced into the structure of the fixed income curve, I personally think that's going to kind of leak out a little bit. I thought it was very interesting just in the last 24 hours. You had some really, really good data yesterday, very strong survey data from the New York and the Philadelphia Feds. You had a really good jobless claims number. Rates popped up, but then they faded throughout the rest of the day. And then you walk in this morning, oil prices are higher, but treasury yields continue to leak lower. I mean, they made new lows on the week. So, it seems to me like the markets are willing to at least consider that, hey, maybe this guy can pull this off. He can bring inflation under control without having to raise interest rates.
Yeah, that's a very good point, and kind of contrasting him to kind of prior Fed leadership, because I think he definitely has a market bias in terms of kind of his experience and how to maybe affect change through other mechanisms than outright rate increases, which is those are typically upsetting to the market, right? But I think it's a very, very valid point.
Yeah, it's a blunt tool, right?
Right.
And nobody ever denies that, but moving rates up
Right.
and down is a fairly blunt tool. So I think he's trying to do something different. Anyway.
So, Stephen, like with that kind of backdrop, what do you think is the implications for the credit markets, right? Like for spreads, which are so tight, what are the implications for tightening financial conditions on the credit market?
Yeah, I mean, I think as long as it doesn't kind of disrupt the underlying fundamentals of businesses,
Right.
In a disproportionate way, I think it's the market can absorb it, and the credits in the high yield market, the companies in the high yield market can absorb it. Typically,
Right.
I mean, high yield, if you think about, just given kind of the embedded nature of incremental spread versus like an investment grade market, it doesn't follow that a rising treasury rate environment necessarily kind of leads to spread widening. I mean, there's more room to kind of absorb spreads, but I mean, the other part of the picture is just kind of around what fundamentals look like in terms of company performance. So I think you can see a situation where he's successful and kind of gradually implementing the tightening of financial conditions, but not disrupting the overall fundamental picture and kind of companies' ability to generate revenue, grow revenues, and generate cash flow and have balance sheets in good shape. So I think that's the hope. I mean, obviously it can actually go counter to that, which would be kind of I think a lower probability case, but one that still exists around if financial conditions are tightening such that and maybe rates are reacting to that effect, and then spreads are widening. That's a kind of bad recipe for companies, obviously, with more leveraged balance sheets.
So I should have probably asked you this before asking that question, but why are credit spreads tightening so much in high yield, right? Like I remember when I started covering these markets, anything below 400 was considered, that's impossible. It's never gonna. But now we are looking at below 200 at some point, or hope not. But why are they tightening, and what is structurally changed in this market that is helping all this?
Yeah, I mean, I think it's interesting if you look at kind of broad. I mean, you can kind of segment the market and spreads by ratings categories, which is something we look at a lot. And you're right. I mean, if you look at the overall index, it trades at like 260, 270 over, but that's comprised of double B, single B, and triple C. So double B being the biggest part of the high yield market. I mean, that has a disproportionate weight in terms of kind of the overall index spread. But you're right. I mean, I think that the 10-year low on the overall index was 250 basis points over. We're at 265 or 6 now. So historically, it's very tight. I think we've had accommodative monetary policy for a long time. There's been a lot of kind of on the fiscal side stimulus, and that's kind of supported companies. And I think there's definitely been as I kind of contrast this to the 2007 period, where it was more ebullient period in terms of people willing to take on more leverage, companies having a higher tolerance. Their balance sheets, I think, are definitely in better shape today than they were in that period. So to me, it's kind of investors' comfort level. Like the other part leading into this, I think we've kind of discussed this, is just around like what the all-in yields look like, right? They're attractive. They're 7%. So we're in a treasury environment that we haven't, that in 2021 was anchored at the bottom. So yields were atypically and abnormally low for high yield. And now I think, with a 7%, level on the index, and double Bs are 6, and you just get kind of the corresponding tightening on the spread side. But so I mean that's the on the overall index, and then double Bs are 10-year lows too. They're 155 over, and I think we hit the low earlier in July, kind of pierced 150. But then look at the triple C category, where that index trades at almost 800 over. That one's been widening throughout kind of the year. I mean, it's 150 basis points or so wider than when we came into the year in January. Whereas the overall index and the double B side are tighter than kind of where we came into the year. So I think there is a little bit of differentiation in terms of analysis for different types of credits. But again, the triple C part of the market's the smallest part of the market, so it'll be outweighed. But if you kind of break that ratings category out by itself, I think it's reflective of not everything is kind of painted with the same brush in terms of kind of spreads being at historical tights. Because I think if you look at the triple C part of the market's 300 basis points or so off of its low, which was 2021. But
in some sense, the average spreads are kind of masking
correct
a market which is kind of differentiating. It's not going all in with all kinds of riskier credits. Yeah,
correct.
And so one of the other things which I wanted to ask you about is about the default rates, right? So that part of the reason people say the fundamentals are strong is because default rates are very low and expected to go lower. Could you kind of take us through why default rates are so low?
Yeah. Certainly they are low historical, and it's interesting to kind of, you look at default rates between the term loan market and the bond market. They're lower in the bond market. They're sub 2% on the default rate. I think term loans are in the mid 3s, and term loans largely a secured market. The high yield market's largely unsecured, although there's a greater percentage representation of secured bonds in there now. But I think default rates are historically low, and I think a lot of people that have been doing this for a long time will probably tell you the bias there is probably for it to move higher. Just kind of mean reversion to the historical averages. But I think the phenomenon of them being low is a result of a couple things. One, what we just spoke about, the fundamentals. Cash flows look great. Leverage is I think the leverage on the market as a whole is 4.5 times gross. So, and again, that'll mix in a lot of the triple C type names that have, elevated leverage, but the double B balance sheets, for a lot of the names are in just fantastic shape. I think they've got either a combination of longer term, low coupon debt that's making cash flow and coverage ratios look a lot better. I mean, people that issued bonds, whether they were smart or not in 2000, late 20 and 21, I mean, they have coupons where U.S. Treasuries are now. And so that really helps in terms of your credit metrics. The other thing is around just kind of some more structural elements about companies and law firms being aggressive and active around these liability management exercises. They call them LME is the acronym, and it can take a lot of different permutations. What that means, there's different abilities for companies to kind of prolong having. I mean, the default rate, most at its most basic, is just you don't have cash to pay interest. There's other kind of technical defaults you can run into, but take that first example where you don't have your business is not generating sufficient cash flow and it's hard to raise financing. These LME exercises have been actually being able to kind of carve out assets to monetize and maybe raise liquidity in a situation where previously you may not have been able to do that with kind of trying to raise it against the existing group. But if you have a clean asset group of assets that don't have or not providing guarantees to other parts of the capital structure, then those have facilitated capital raises that have, probably in a lot of cases either eliminated bankruptcy or defaults or prolonged them. So I think it's kind of the combination of those two things, with fundamentals still being pretty firm, and then balance sheets are in good shape. And then
so Stephen, is delaying bankruptcy a good thing?
I mean, if you kind of want to believe companies in terms of giving them time to enact turnaround plans,
right?
I think the counter to that would be, well, is value getting siphoned off from a creditor group to the benefit of equity holders? I think the sacred law was always, in terms of kind of hierarchy or pecking order, creditors come first. I think some of these we've seen where equity has been the beneficiary, probably to the detriment of creditors. So I think in that case, if you're looking at it through the pure lens of the high yield market, it's not good. And I think what banks and some investors will want to tell you is, if they've lost confidence in a management team, so they want to arrest their ability to try to put in place a turnaround plan. They may have a view around, we can operate this better, or prioritize capital allocation in a different manner that we think we can do it. So in that sense, like, if you're prolonging it, you don't get the chance to kind of impose or involve yourself in it. Yes, I mean, I think it's probably it's not a good thing for the creditor side. But again, like, I think you'll see probably some that management teams have been successful in kind of monetizing and kind of reorienting the business. And I mean,
so buying time could mean so many things, right? Like, it could also mean you have more time to rebuild your business, but buying time also could mean you're putting more money into a business which might not recover as well.
Correct. Yeah.
So, Steve, sorry, Shank. Stephen, could this effort by the Fed to generally tighten financial conditions, does that change your outlook on spreads and default rates? I mean, in theory, it would put a bottom in spreads and potentially a bottom also in default rates. Is that part of the conversations now, or is that?
No, for sure. And again, it gets back to kind of the differentiation in the market. And I'm not going to be the one to kind of call the floor on spreads and default rates not going lower, but my bias is like they're kind of anchored to a low point that will likely increase. So and again, like, to the triple C side of the market, there are definitely companies there that have stretched balance sheets, and financial condition tightening can be pretty acute for them, I think, because they don't have a lot of cushion on time in terms of kind of where their cash flow coverage ratios may look like. And the bond market versus the loan market, in that sense, why people kind of express preference for bonds at times in a rising rate environment, like you have fixed rate debt, whereas in the loan market, which we probably haven't talked about as much, but I mean, it's a equally sized market. But they're both almost $1 trillion, $4 trillion, $5 trillion in notional outstanding. The ratings composition looks different between the two, whereas the high yield market is half or a little more than half double B, and the loan market is kind of half to a little more than half of single B names. So smaller credits probably like less able to withstand a tightening in financial conditions. And then you pair that with the floating rate nature of their debt, like, so that can kind of cut you both two ways.
Right. So, like, part of the game, if I can call it, is to keep being able to refinance debt through different cycles, right? Because they are shorter term in nature. So do you think this whole inflationary part, or how the economy is going at this point, or the war which continues, does it expose a lot more companies next year probably, or if not this year?
Yeah, I mean, I think high yield companies or leverage companies are typically very intentional about managing maturity
Right.
walls and the maturity profile of their capital structure, much more so than investment. I mean, in theory, I always think of the investment grade market as typically kind of always open at a price.
Right.
Not really true of the high yield market. So, yeah, I think in terms of kind of there's not a big maturity wall in 2027 of bonds like in the high yield market because those have already been taken care of. So, but you're right. I mean, I think people, and that may be why there's a bias to action this year in terms of getting ahead of if we are in an inflationary environment and you are trying to assess where rates are going to go and you think
Right.
they are going to go higher, then yeah, I think now, like what we talked about earlier with where spreads are, and even overall yields, historically, or they're not at the nadir, but they're pretty attractive. And so,
Right.
yeah, if that's kind of the lens you're looking at it through, with where rates are going to go potentially in the future, again, like no one's running up against maturities. They just because we know what it can happen in terms of market access and market
Right.
windows with shutdowns. So they're much more intentional and proactive around managing maturity profiles. And that's why most of the market has callable structures and
Right.
you get ahead, like unlike investment grade where you need to kind of wait 3 to 6 months prior to the
Right.
maturity to not have to pay like a make whole premium.
Right.
I think your assessment around what companies' views may be and what we try to advise people on is this is a pretty attractive market.
Right. And so is that one of the, when there is so much demand going on for yield, is that the reason for the massive increase in issuance this year? Like we are seeing record levels of credit issuance in primary markets.
Yeah.
Could you, like, is that the main reason in high yield, or
No,
like,
I think like it's interesting, like when you look at kind of that dynamic right around, and I think this holds for investment grade, probably more prominently in the investment grade market than high yield, but
right.
high yield's definitely been light on the M&A side this year, I think. But if you look at kind of what's been issued in terms of AI related
Right.
adjacencies with whether that's kind of like the neo cloud guys like a CoreWeave or just the real estate pure play data center guys that are getting these things off the ground. I mean, that issuance is over $30 billion this year in the high yield market. It was
All right.
12, 14 last year. So, and we're just a little more than halfway through the year. So that's really kind of made up for the M&A, just that side of the market being light. So, and
Right.
that's more true on the investment grade side where you have all the hyperscalers
Right.
and chip companies, issuing debt. So yeah, I think the issuance this year, if you kind of look at, if you break it down into kind of its components, is refis for 28, 29 maturities, and then this 30 billion of AI issuance, which is
Right.
if we've done 180 on the primary side this year, I mean it's almost 20% of the market,
Right.
and likely probably to grow in the back half of the year. I think I've seen some estimates put that number at 90 billion for the year, which is
Wow.
just
So
incredible.
60 billion more?
60 more, yeah.
Wow.
Yeah.
So first half you do 30,
I
now
know.
you double it.
Yeah.
Yeah.
And from 14 last year, yeah.
So,
And
but
I think we made the point. I
yeah.
mean, like there's I think two of the largest 8 individual kind of tranches in high yield now are data center or AI related names. And these are the multi-billion, $4 and $5 billion deals for first time issuers, which previously is kind of that would be
Right.
just foreign concept.
Right. But Stephen, this whole AI, the makeup of the kind of issuers who raise money for AI in high yield is different
Correct.
to the one in the high grade, right? So they are the
Yes.
big hyperscaler. What
Yeah,
kind of issuers are you seeing?
yeah, no, it's a very interesting subsector of the market now, and I think people have been very smart about kind of how these deals are structured. they are, you take it at kind of its most basic, like if you're constructing a data center for a tenant, like I almost view it like a tenant lease, how a lot of these are structured, because your ultimate credit exposure is often backstop to one of these,
Right.
Either a hyperscaler or one of the chip companies. We've seen, we're looking at one that the lease guarantee is provided by, there's a data center company that's going to build and operate and get it off the ground, and then there's the tenant, and then there's a chip company behind the tenant. So it's kind of got a double
dip
guarantee, like lease
Yeah.
stream almost for some of these, and the structures are very bespoke in that they fit with inside kind of the guarantee of the lease term. So those are the types of deals that have been done in the high yield market. And I think the shorthand or simplistic way to look at it is, if you're pricing these bonds at 6.5%, and it's a 5-year bond that has a 5-year lease that's guaranteed by an NVIDIA or a Meta.
Right.
I mean, isn't that equivalent NVIDIA or Meta risk if it's like a formal debt guarantee and you're being paid well in excess of what you would earn on a Meta or a NVIDIA bond, high grade financing. But so everything's kind of tied in ecosystem wise to like what the money being raised in the investment grade market. I mean, maybe that's kind of like some of that money is backstopping these guarantees, but it's very circular to me, like how everything works. But I think the bonds, and at least in the high yield side, look a little different than your regular way high yield bonds, because they're all, or 90, the vast majority of them are 5-year in term to kind of fit inside the term of a lease, and they have these kind of, which is a vestige of something in the old high yield market, a sinking fund, which they used to call it, which is almost like it's like an amortization payment. So they have those associated with them, and really your credit exposure is being smart around lease terms and that's almost kind of what you're underwriting, rather than doing a bond deal on a loan to value basis where the land you think is worth $1 billion and you're lending them 40% or 60% of the cost. It's a little bit of different analysis, but I think it's a very interesting part of the market, and it's evolving week by week.
Which brings us to the point where everyone is worried about leverage building in AI. What you're almost saying is there is this circularity with these large hyperscalers raising billions of dollars in the high grade market, and then guaranteeing debt being issued in billions of dollars in other markets. And so is that a concerning factor, you think? Like, is that what people should be concerned about?
Yeah, I mean, I think you need to absolutely kind of pay attention to kind of the guarantees being extended to a lot of these companies that are like either the constructor or the operators of these data centers. I mean, they're buying their own supply in a sense, or in their supply, however you want to call it, like vendor financing or but yeah, there's a clear tie-in to like how the revenues will go back and forth, and it's just but yeah, like you say, I mean, if it's debt like and it's guaranteed, then you need to pay attention to kind of the ability. And all these companies have like the best business models in the history of the world, right? I mean, they generate like incredible amounts of cash flow and have I'm thinking about like the hyperscalers. I mean, they just have incredible business models that allow them to do this. But again, like there's a point, I think, at which the amounts of guarantees will if not cause them to be downgraded, but like, I mean, you need to have more awareness, I think, of kind of what they have maybe on these types of structures, guarantee wise.
I mean, we're having one of those little moments in the market this morning. When I turned the screens on, there was a Chinese AI company called Moonshot that came out with a model that was pretty close to Anthropic and chat.
Yeah.
And it was, and they're already going, this is like another deep seek.
Deep seek,
Remember the whole deep
right.
seek?
Yeah.
It's like, but we go through these flare-ups where everybody's concerned about the circularity of the whole
Yeah.
business. And then, a week later, it's like, carry on.
Yeah. It's like, it's just kind of like the market phenomenon writ large, right? Like, I think if we rewind like a decade ago, if you would say if you could kind of outline like the war in Ukraine and the war in Iran and like this the market like shrugs a lot of it off until it doesn't. But like you're absolutely right. I mean, I think just the amounts of capital being invested in these companies, and I mean, you really are kind of betting on the product being the best in class and kind of and paradigm shifting, right? Like, because the amounts of money that are being raised, but then you see like the DeepSeek situation in early January of 25, and they're replicating the functionality on a much lower cost base. And sounds like this situation, I'm not aware of the one that you were speaking of this morning, but everyone's pursuing it. So I think, and there's been a lot of interesting kind of studies and analysis around how this Capex cycle dedicated to AI relates to past cycles in terms of spend versus GDP or spend versus the company's balance sheets. I think if you look at kind of the cap in contrast to kind of what happened in the telecom cycle in the early 2000s or energy and shale, the build out or the cycle there.
Right.
It looks like kind of similar on a GDP basis. What the spend represents in terms of percentage of GDP. I think where it looks better is just like how these companies, like we were talking about, Metas and Alphabets and Microsoft, just what those companies' balance sheets look like and how they're able to kind of support the spend looks different. But I think the capital expenditure cycle has been one that's been studied, and there's a lot of examples where it reaches a point where it's the marginal dollar spent does not generate sufficient return. I think that's what people are like looking at in terms of how this is gonna
play out. Yeah,
it's probably early, but I don't know. I think a lot of the narratives now you're hearing around what's the economic case for companies to adopt and what how the effect on their spend is. And we use it all the time, and I don't have visibility into like what it may cost in terms of usage rates, but like you read about it, and some companies like going through their AI budgets 6 months that they had allocated for a year. So I do think it's a very productive and useful, time-saving, efficient tool that we use I use daily.
Right. No, but Stephen, one of the things which is very worrying is like they're spending billions of dollars, and then it almost seems like it's not enough. And the question then comes to your mind is, do they really know how much do they need? And what are they trying to achieve, right? Like it's almost like a never-ending pursuit of spending. And then if you're using some of the money to guarantee someone else to raise more debt, it's like, what are you creating, right? Like it's a very strange.
And also how much does the race with China play into this?
Yes.
Just the fact that, hey, we can't let those guys get ahead, and everybody just keeps trying to outspend each other.
Right. Yeah. So, but Stephen, in this case, like how are investors reacting to this? Obviously, they have already seen this happening, or they're worried about certain things. Do you see any impact on the way people are responding to, say, the bonds or the leverage loans which are coming out for this particular purpose? Or they're very happy with the guarantees?
Yeah, no, they are, but I wouldn't say like the bonds have like kind of converged to trade near where the company's backstopping the guarantees trade. I mean, they actually probably, I was looking at a couple of them the other day. I mean, some are below par. So that's the interesting thing. I think, there's definitely kind of and this is not like a new statement, but there's always divergence between kind of credit opinions or credit analysis and equity.
Right.
I think in a frothy market, like credit guys start thinking like equity guys. But there does seem to be like not kind of the froth to me, like on the credit side, high yield. And I think you've even seen in some of the investment grade markets. I don't follow that one as closely, but obviously the SpaceX deal like has
Right.
traded very poorly. Like the equity's catching up now. I mean the bonds traded off before the equity did, and I think
Right.
the Amazon deal that they did, was it last week, has not traded well. So I think there's definitely, to your earlier point around the billions, and like the billions are nearing kind of a trillion now. I think like
Right.
the
Right.
26 number is like 750, and the 27 number is like $950 billion, which is like a hard number to even kind of contemplate. I mean, that
Right.
was almost like the size of the investment grade market. And that's not all debt finance, but a lot of it is. And like, I mean, that was, the $1.2 trillion market, like, several years ago in investment grade that was
Right.
the year. And that was, a lot more companies than a handful of the, these
Yeah.
hyperscalers for sure. But yeah, it's
So, that is interesting because in the investment grade market, you're seeing new issue premiums going up, right, to double digits. And still the bonds are trading wider, right? Like, so it's almost like they're still think it is mispriced.
yeah,
Maybe we need to ask bigger concessions,
yeah.
and probably the next deals which
The
come
next
in.
one, yeah, you're right. Yeah, I think the next one, they're getting incrementally more expensive to do.
More expensive. Yeah, correct. And is that like, do you think there is a lot of focus on issuing in dollars, right? Obviously, deep markets,
Yeah.
the world's investors come here. And there is a move to diversify a little bit funding to other areas. But do you think dollars will remain the prime source of this funding for
Yeah,
AI?
I mean, there's definitely a cost arbitrage typically between markets, just given kind of where base rates are in Europe versus dollar. So if you hold kind of parity around spreads, then yeah, you could probably issue cheaper in euros. Not so much the case in sterling, but I
Yeah.
think the real question or the appeal of dollars is just like the depth of the market and how much you're able to kind of take out. I mean,
Right.
yeah, I don't know the relative sizes of like investment grade dollar markets versus euros, but like the investment grade high yield market is
Right.
multiples the size of the euro market. So companies that have cash flows in Europe, which all these businesses are very global in nature, absolutely do. They will avail themselves of different funding markets and different currencies. And there's ways to kind of synthetically do it too with cross currency swaps, which is a
Right.
big part of the market. That we're actively engaged in with our
Right.
derivative counterparts, so you can kind of synthetically do it. And again, like the cost arbitrage on the coupon side is certainly there. It just, to me, it's more just a capacity question. I like Amazon, their deal, or Oracle's deals that were $25-30 billion. I don't, and again, like I'm not the expert on the investment grade market, but I think
Yeah.
those would be more difficult to execute in the just
Right.
give depth of market and investor base there.
And like I wanted to ask you, like, are there, obviously AI is a thing which we have to watch how this whole funding thing goes, how the circularity of funding, as you mentioned. What other red flags should people watch for in the high yield market? Like, do you think default rates are going to rise or should rise, or how do you look at the market?
Yeah, I think again, like not to kind of be repetitive on my earlier statements around the segmenting of the market, but you do need to look at it kind of on a sector basis in terms of just sector by business type, and I think by rating. So
Right.
ratings will kind of put you into the category of where companies' balance sheets may be in a more fragile position than a higher rated company, which is an obvious statement. But again, like I think you look at some of the sectors that may be feeling more pressure, and I like look at earnings by S&P sector to kind of get a read through around this. Like obviously the ones that are doing well, energy with commodity prices is helpful for the producers and kind of the adjacent companies in the energy sector. as long as the AI spend keeps going, those companies should do well. Some of the legacy businesses that have struggled on the media side or telecom side,
Right.
those have been challenged, and I think
Right.
they may continue to be so. And back to Bruce's earlier point around kind of tightening financial conditions, like the effect there is more acute on those companies that either have weakening fundamentals in terms of revenue and cash flow performance. And I'm thinking some of the legacy,
Right.
regional cable companies. There's a lot of those in the high yield market. Some of the old media content producers that we saw, and Warner Brother. I mean, they were a big
Right.
high yield issuer. They got downgraded, and I mean, obviously that business is either underway with the M&A transaction with Paramount, but those bonds trade not like reflective of probably the scale of that company and size. I mean, it's got leverage, but it's got, again, trends there. And then the other thing I look at is just kind of some of the consumer discretionary names. I mean, the earnings there have been weaker than they have been for some of the other names. So to me, it's going to be an analysis of ratings and some of the sectors. Healthcare hasn't been, some sectors, some areas of healthcare have been a little bit challenged too. And you've got the big government I mean, there's just like legislative pen risk there, like as there always has been, but it's a very dynamic market on the healthcare side. So, and I think AI, I mean, eventually you could make a case where that one may fall into some of the more challenged parts of the market. And again, like, I think you need to be smart around how the leases are structured, what the guarantees look like, and what the walkaway rights may look like. But again, like, those deals have been finding pretty warm reception by investors to date.
So are you expecting, they call them fallen angels, right? Like people downgraded from high grade into high yield. Are you expecting a lot of that happening with all this AI spending and leverage building?
No, I mean, I don't know. Oracle's always the one that's been like probably the closest on the precipice to being downgraded, which I think people are discounting that they will be. I mean, they've shown kind of a willingness to use equity in some of these financings, but there's always movement up and down, right? I mean, I think this is definitely something that our credit team pays attention to, just around ratings migration between going both ways, like rising stars and falling angels. So we had a couple last year. I mean, Warner was the biggest one. And my bias around, or my view around kind of the fallen angel phenomenon, is those companies typically, they're not going to like the coupons they pay versus what they previously enjoyed as an investment grade issuer. But those companies like actually tend to do fairly well relative to the high yield market. I mean, we had a couple last year, Nissan, Celanese, Warner. They kind of tend to issue at the higher end of high yield. I mean, they're usually big scale global businesses that may have taken on leverage to do an acquisition or to fund some type of capital projects or share buybacks. Most of them have aspirations to go back. So yeah, it's more the knock-on effect, I think, with fallen angels is a company like Warner comes into the market, and investors that you need to own the index. Same kind of phenomenon with equities, right? Like, if a big new name comes in, and that'll have effect on other credits that people need to sell to raise cash to buy that one. But in terms of kind of access or ability to kind of finance, I think those companies do pretty well, unless it's like an existential business risk. If it's a leverage and a temporal thing, then I think they finance themselves pretty attractively.
One of the criticisms that I hear quite often in the macro community is that the circularity, the scale of all this, as you were describing, for the second half of the year, that investors, it's often claimed investors really don't understand the risk they're taking. They don't know how to properly assess risk. And okay, well, I don't know about, what's your view on that? Seems to me that, and what I hear you saying is that, people are going into this with their eyes open, or your customers are going into this with their eyes open, and they are in fact able to correctly assess risk.
Yeah, no, I don't think they're just like wantonly throwing money at these companies because the market's been performing. So yeah, you can tell by how they're structured, right? I think there's attention to kind of having safeguards or protections built in for some of the eventualities maybe that should they occur. So yeah, I don't think it's yeah, I wouldn't say it's a
So
like
so people aren't whistling past the graveyard here.
yeah, good phrase. Yeah.
Right. Okay. All right.
Actually, and the other thing, Stephen, I wanted to ask you is, there are lots of finance graduates out there. How do you become a Stephen Burgess? Like, what's the secret sauce there?
Yeah, I think there's multi-path, and I used to do a lot of the interviewing. I still do some of the interviewing. So I think what I always kind of look for is, and it's not necessarily, I don't think you need to be, I was a finance and economics major, but I don't think that's requisite to kind of come into the
Oh, wow.
field as an analyst. I think it's helpful in terms of if that's your interest, and it gives you something to talk about in interviews. Kind of cut both ways, right? If that's your major, expect a lot of questions around those types of topics. But I think we just want people that are have kind of a self drive, that are interested. You can be an English major and be very interested in the markets too, right? So I don't think that's disqualifying, and I always enjoyed talking to people that had different, liberal arts backgrounds, or as well as the ones with finance or economics. So it's, kind of a self drive interest in kind of the product and the markets, and just being very intellectually curious about things, wanting to learn. It's definitely you work in teams. Don't think of this as you get assignments and you kind of go off and kind of work independently. So I think those those elements or attributes are ones that we look for. I always look for. Are you a curious person? Do you like to dig into problems and kind of work in a fast-paced, dynamic environment? Then I think it's a great spot.
And since we spoke so much about AI, do you think AI is going to disrupt this part of the business in the bank? Or
I think it certainly has the potential to alleviate or make more efficient some of the more time-consuming tasks. And this is not a novel statement for me. I think you've seen it from a lot of the leaders at some of the banks, that whether that's kind of creation of pitch books, whether that's comparison of indentures or credit agreements, that can actually be done very, very quickly. I mean, you may not need as big an analyst team. There's still an interpretive element, I think, to the job, and there's qualitative aspects to it. I think people are going to run companies, so our advisory services, I think we're going to be pitching to people. I hope companies are not run by agents,
robots.
But so it's I think you're right. I mean, I'd be foolish to say that there will be no impact, because I think there's definitely efficiency gains to have. If that means teams are smaller, I think that's probably the logical kind of at least kind of first order effect in terms of what it may mean. But yeah, the ability to use these tools is pretty compelling in terms of time efficiency. We all know how long and dense legal documents can be, and they're very important for high yield and in the loan market. These terms, and we spend a lot of time studying them and kind of benchmarking against others. That can be done very quickly. And again, there's an interpretive element, and we need to assess that in the context of the credit, because there's definitely qualitative elements of credit analysis because there's management teams, there's your perception of their product and the market, and
Right.
strategy assessment. So I think on the edges, though, the AI thing is something that will certainly have an effect on
Right.
early careers, middle level careers, and probably upper level careers too.
Right. Thank you very much for that, Stephen. And that's all we have time for. And thank you very much. That was great. And I learned a lot of stuff about the high yield markets, which
me
amazing.
as well. Yeah.
Yeah.
Okay. Well, great. It's great talking to you guys.
Terrific.
Thank you all thank you very much, Steve. Thank you very much.
Have a great day.
And thank you all for listening to us. Subscribe to Credit Matters on YouTube, Spotify, Apple, or wherever you get your podcasts, and tune in next week where we'll have another special great guest, and we'll dig into the latest credit events. If you want to receive real-time reports and market data, you can request a free trial of IGM services. The link is in the show notes. Thank you again, and have a nice weekend. Thank you again, Stephen.
All right. Thanks, guys.
Thank you.
Good weekend.